Welcome, dear listener, to The Long Game. This is the podcast where we take time to look deeper, beneath the headlines, beneath the financial reports, and sometimes beneath the smile of a stock chart that's rising. Today, we begin a new journey. A journey into a corporate move that sounds simple, but isn't. That looks smart, but might be deceptive. And that, depending on who you ask, is either brilliant or dangerous. We're talking about share buybacks. Let's begin right at the start. A share buyback is when a company uses its own money to buy its own shares back from the market. That means there are fewer shares left in the hands of the public. And when that happens, the earnings per share usually go up. Sounds like good news, right? For many investors, it is. Fewer shares, higher earnings per share, often a rising stock price. It feels like the company is rewarding shareholders. But is that always the case? Or is it possible that this move hides something? That the company isn't growing, that it just wants to look like it's doing better than it really is? In this episode, we're going to ask, why do companies buy their own shares, and what really happens when they do? Because behind the math, behind the announcements, behind the rising chart, there might be something else. In part 1, we'll lay the foundation. We'll break down exactly what a buyback is, how it works, and what the company is really doing when it makes this move. Let's begin with this idea. A share buyback is not growth. It doesn't create new value. It simply changes the shape of the value that's already there. Imagine a pizza. Same pizza, same size, but fewer people at the table. Each person now gets a bigger slice. Not because the pizza grew, but because the company took some chairs away. That's how a buyback works. The total profit of the company stays the same, but there are fewer shareholders now. So each remaining shareholder sees more profit per share. That's called EPS, earnings per share. And when EPS goes up, stock prices often follow, at least in the short term, and that's exactly why many companies love this move. They don't have to grow. They just need to reduce the number of shares, and suddenly the numbers look better. But here's the twist. Looking better is not the same as being better. Some companies use buybacks when they're doing well. They've grown, they have extra cash, and they want to reward investors. But some use buybacks to hide, to cover up weak growth, to please Wall Street with prettier numbers, even if the business itself is standing still. That's why this topic matters. Because on the surface, buybacks look the same, but the story underneath can be very, very different. So, in this 10-part series, we'll ask, is a buyback a smart move for long-term investors, or is it financial makeup, a way to smooth the skin without healing what's underneath? In part 2, we'll look at the history. When did buybacks become popular? And how did we get to the point where companies spend trillions of dollars buying back their own stock? The story of buybacks is also the story of how modern capitalism evolved, and we'll trace it together. Thank you for listening to The Long Game. This is only the beginning, and trust me, what's coming next will surprise you.
Welcome back to The Long Game. In the last part, we asked a simple question. When a company buys back its own stock, is that a smart way to return value to shareholders? Or is it just financial makeup? Today, in Part 2, we go back in time, because to understand share buybacks, we need to know where they came from and why they weren't always seen as normal or even legal. Let's rewind the clock. Back in the early 1900s, stock buybacks were viewed with deep suspicion. In fact, in the United States, companies were often discouraged and sometimes outright forbidden from buying back their own shares. Why? Because buybacks were seen as market manipulation. Think about it. If a company could quietly buy its own shares, it could push up the price, mislead investors, and cover up weaknesses. That made regulators nervous. It felt like cheating. So for most of the 20th century, companies avoided buybacks. They paid dividends instead. Dividends were simple. They handed real money to shareholders, and that was seen as honest. But everything changed in 1982. That year, the U.S. Securities and Exchange Commission, the SEC, passed Rule 10b-18. This rule gave companies a safe harbor. If they followed certain rules, they could buy back their own shares without being accused of manipulating the market. It was a turning point. Suddenly, buybacks became legal, accepted tools, and once that door opened, companies rushed in. In the 1990s and 2000s, buybacks grew fast, but it was after the 2008 financial crisis that things truly exploded. Why? Because interest rates dropped, borrowing money became cheap, and instead of using cash to expand or hire more workers, many companies used it to buy back stock. By the 2010s, U.S. companies were spending hundreds of billions of dollars a year on buybacks. In fact, in some years, companies spent more buying back stock than they did on research, development, or even paying dividends. Buybacks had gone from suspicious to common to dominant. But here's the strange part. While investors often cheered the short-term boost in share price, many critics began asking, is this really healthy? Some economists argued that buybacks were turning companies inward. Instead of investing in the future, they were just rearranging the present. Instead of building better products or training better employees, they were giving shareholders a sugar rush. So who's right? Are buybacks a mature, rational tool, or are they the financial version of fast food? Tasty, but hollow. In future parts, we'll dig deeper. But let's stop here and take a moment to reflect. Today's biggest companies, Apple, Microsoft, Alphabet, Meta, and others, have spent tens of billions of dollars on buybacks. In fact, Apple has done more buybacks than any other company in history, over $500 billion worth. Why? Because it works. It pleases investors, it supports the share price, and it sends a signal we believe in our stock. But here's the question we'll keep coming back to. Is it belief or is it branding? When a company buys back stock, what exactly are they saying? And what are they not saying? That's where we're headed next. In Part 3, we'll explore the motives. Why do executives love buybacks? What incentives are hidden in their bonuses and compensation packages? And are buybacks being used to serve shareholders or just to serve the people in charge? You won't want to miss that. This is the long game, and we're only on Part 2. There's so much more beneath the surface. Let's keep digging.
Welcome back to The Long Game. We've talked about what share buybacks are, and we've looked at how they became popular, even dominant, in modern corporate finance. But now it's time to ask something deeper. Not just what companies are doing, but why they're doing it. Because behind every financial decision, there's a motive.
And when it comes to buybacks, the motives aren't always as pure as they seem. Let's start with a familiar phrase you often hear in press releases. We believe our stock is undervalued. That's the official reason companies often give for buybacks. They're saying, in effect, we think our shares are cheap right now, so we're going to invest in ourselves. Sounds confident, right? It's like a company saying, if we had to choose between buying something else or buying us, we choose us. That's a powerful message, but is it always true? Let's take a closer look at the people making these decisions. Company executives. CEOs, CFOs, and other top leaders often receive a big portion of their compensation in stock-based incentives. That means the higher the stock price, the bigger their payday. Sometimes they get stock options. Sometimes they get bonuses if earnings per share go up. And buybacks do both those things. They reduce the number of shares and increase earnings per share. So here's the concern. Are executives doing buybacks because it's the best long-term move for the business or because it's the best short-term move for them? There have been cases where buybacks were announced, and right after that, executives sold millions of dollars worth of their own shares. It doesn't look great, does it? It raises the question, who is the buyback really for? Let's imagine two paths. A company has $10 billion in free cash. Path 1. It uses that money to invest in new products, new markets, and new people. The payoff may take years, but if successful, it could build real, lasting growth. Path 2. It uses the money to buy back shares. The stock price might jump in a week. Earnings per share go up, and Wall Street smiles. Which path would you take if your bonus depended on the stock price this year? That's the conflict. Short-term reward versus long-term value. And when incentives lean toward the short term, buybacks can become a tool for looking good now, even if it costs the company later. Of course, not all buybacks are bad. Some are done with care, with purpose, and with long-term thinking. Some are truly returning excess capital to shareholders when there's nothing better to do with it. But others are more like stage lighting. They cast a glow even when the room is empty. And here's where it gets tricky. Buybacks are legal. They're allowed under clear rules. They're accepted by the market, and in some ways, they're expected. In fact, if a company doesn't do a buyback, some investors may wonder, why not? That pressure can push companies into buybacks, even when other options might be healthier. And sometimes the best move for the business, like investing in workers or building better systems, doesn't get chosen because it doesn't immediately raise the stock price. That's the real danger of misused buybacks. They don't just change the math, they change the mindset. So the next time you hear that a company is buying back its shares, ask yourself, is this confidence or is it a cover-up? Is it a reward for shareholders or a shortcut to executive bonuses? Because the numbers don't always tell the full story. In Part 4, we'll go inside the numbers. We'll break down what actually happens step by step when a buyback takes place, how it affects earnings per share, the balance sheet, and the perception of value, and how sometimes a business in decline can still look like a business in growth just by buying back stock. This is the long game, and the deeper we go, the clearer the picture becomes. Stay with us.
Welcome back to The Long Game. We're now in Part 4 of our journey through the world of share buybacks. In the last episode, we talked about motives, about how executive incentives can shape decisions.
and how buybacks, while legal and often celebrated, can be used to chase short-term glory instead of long-term strength. But today, we slow down. We take the microscope and zoom in. Because to truly understand the impact of a buyback, we need to see what happens step by step, financially. So, let's follow the path. Imagine a company. We'll call it Novatech. Novatech has 1 billion shares on the market. It earns $10 billion in profit. That means its earnings per share, or EPS, is exactly $10. Pretty straightforward. Now imagine Novatech decides to buy back 100 million of its own shares. It spends $5 billion to do it. Now, the number of shares is no longer 1 billion. It's 900 million. But the profit hasn't changed. It's still $10 billion. So now the new EPS is higher. $10 billion divided by 900 million shares equals $11.11 per share. Suddenly, each remaining share looks more profitable. The company didn't make more money, but the earnings per share went up just by shrinking the denominator. That's the first key point. Buybacks improve the appearance of profitability without changing the actual profit. And here's where psychology steps in. Many investors and even some analysts look quickly at EPS. If it's rising, they get excited. They assume the business is doing better. But in this case, it's not performance that's improved. It's just math. Now let's look at how buybacks affect the balance sheet. When Novatech spends $5 billion to buy its own stock, that cash disappears from the company's books. Assets go down. But the number of outstanding shares also goes down. And depending on how the buyback is financed, cash or debt, the company may take on new liabilities. If Novatech borrows money to buy back shares, which many companies do, it's now more leveraged. Its debt-to-equity ratio rises. It's more fragile in a downturn. So while the surface looks clean and shiny, with higher EPS and maybe a rising stock price, beneath it, there may be more risk. That's the second key point. Buybacks can quietly increase financial risk, especially if debt is used. Now let's look at how it affects valuation. Suppose Novatech trades at 20 times earnings. Before the buyback, with $10 EPS, the stock is worth $200. After the buyback, the EPS rises to $11.11. If the price stays at $200, the PE ratio is now lower. It looks cheaper. Or the market may react and push the price up, maybe to $220, to reflect the new higher EPS. This makes investors happy. But again, nothing real has changed in the company's operations. No new product, no new customers, just fewer shares. That's the third key point. Buybacks can temporarily make a stock look cheaper and then trigger price increases based on that illusion. And finally, let's talk about the signal. In theory, when a company buys back stock, it's sending a message. We think our shares are undervalued. It's a show of confidence. But that signal only works if it's done at the right time. Many companies, however, do buybacks at the wrong time. They buy when their stock is high, not low. In fact, history shows that companies often buy back the most stock right before a downturn. It's the opposite of what smart investors do. Smart investors buy low, sell high. Some companies buy high and then stop buying when prices fall. That's the fourth key point. The timing of buybacks matters. And unfortunately, companies often get the timing wrong. So let's pause and summarize. Buybacks do four main things. They increase earnings per share, even if profits stay flat. They reduce cash or increase debt, which can raise financial risk. They make the stock appear cheaper, which can mislead investors. And they send a signal, but only if the timing is right. None of these are evil, but none of them guarantee strength either. That's why smart investors look deeper. They ask, is this buyback funded by real surplus cash? Is it timed well? Does it come alongside business growth or instead of it? Because when buybacks are used to complement a growing, thriving business, they can be powerful. But when they're used to hide weakness, they're just financial makeup. In Part 5, we'll flip the perspective. We'll ask, what if the company didn't do a buyback? What could it have done with that money instead? Could it have invested in R&D, improved worker wages, expanded to new markets? We'll explore the opportunity cost of buybacks and what gets left behind when companies choose this path. This is the long game. Thanks for listening, and stay curious.
Welcome back to the long game. In Part 4, we broke down how buybacks affect the numbers, earnings per share, balance sheets, valuations. We saw how the math works, but numbers alone don't tell the full story. Today, we zoom out. We ask a question that often goes ignored. What else could the company have done with that money? In other words, what's the opportunity cost of a share buyback? Let's return to our example. Novatech has $5 billion in extra cash. It chooses to buy back its own shares. But let's imagine it chose not to. Let's ask, what else could a company like Novatech do with $5 billion? First option is R&D, research and development. That kind of money could fund years of innovation, new products, new technology, entire new business lines. It could help the company build its next breakthrough. Second option is people. Novatech could raise wages, train employees, attract top talent, keep workers motivated and loyal. In today's knowledge economy, people are often a company's greatest asset. Third option is expansion. Novatech could use the money to open new markets, build new factories, enter new countries, acquire smaller startups with big potential. It could plant seeds for future growth. Fourth option is debt reduction. Instead of taking on new risk, it could become more financially secure, less vulnerable in a downturn, stronger balance sheet, lower interest expenses. Fifth option, dividends. It could give cash directly to shareholders as real money, not just a higher stock price. Dividends reward long-term holders. They're transparent, and they don't require market timing. So why don't more companies choose these other paths? Because buybacks offer something the others don't: speed. The impact of a buyback is fast. EPS rises immediately. Stock price often reacts quickly. Executives get a boost in their compensation, and investors cheer, at least for a while. But here's the problem. Fast is not always better. Think about farming. You can harvest this year's crops early for quick profit, or you can leave them in the ground a little longer, let them grow, and build something lasting. Buybacks are like harvesting early. They can be useful, but if used too often, they leave the soil dry. Many critics argue that the overuse of buybacks in the past 20 years has hollowed out long-term investment in the economy. They point to industries where innovation has slowed, where wages have stagnated, where companies have record profits, but still cut jobs.
And when asked why they didn't invest more in growth, the answer is often the same: we did a buyback instead. It's not illegal, it's not always wrong, but it does raise a hard truth. Every dollar spent on a buyback is a dollar not spent on something else. And the question is, what are we giving up? Because in the short term, buybacks may please investors, but in the long term, they may leave companies less prepared, less competitive, and less connected to the people who helped build them. Now, let's be clear, this isn't a war against buybacks. There are times when they make sense, when a company truly has no better use for its money, when the stock is undervalued, when the move is part of a balanced, thoughtful capital strategy. But what we're asking here is not whether buybacks can be good. We're asking, are they always the best use of capital? And that leads us to a deeper layer, because sometimes the decision to do a buyback isn't based on strategy at all. Sometimes it's based on pressure. In Part 6, we'll explore the role of Wall Street, how investors, analysts, and institutional players shape the behavior of companies, how buybacks can become less of a choice and more of an expectation, and what happens when companies feel forced to please the market, even at the cost of their own future. This is the long game, and we're only halfway there. Thanks for staying with us.
Welcome back to The Long Game. We're now in Part 6 of our deep dive into share buybacks. So far, we've looked at what buybacks are, how they work, who benefits, and what companies might give up by choosing them. But now it's time to talk about something bigger. Not just about companies, but about the entire system that surrounds them. Because companies don't make decisions in a vacuum. They're surrounded by pressure, by expectations, by shareholders, by Wall Street. So in this part, we ask, what role does the market play in pushing companies toward buybacks? Let's begin with a simple truth. Most public companies are judged every 3 months. Every quarter, they release earnings. And every quarter, analysts and investors look closely. Did the company beat expectations? Did profits rise? Did EPS go up? And in that world where quarterly results can move a stock price overnight, buybacks become a powerful tool. Because as we've seen, buybacks increase earnings per share. Even if real profits stay flat, that's the magic. Or the illusion, depending on how you look at it. So imagine you're a CEO. Your company is doing okay, not great. Growth is slowing, costs are rising, and Wall Street expects you to deliver solid numbers this quarter. What can you do? You could launch a long-term plan, invest in something bold, but that takes time. It won't help this quarter. And meanwhile, your stock price might drop. Or you could authorize a buyback. Shrink the share count, boost EPS instantly, and meet expectations without changing your operations at all. Wall Street claps, stock price rises, mission accomplished. That's the cycle. And that's why critics argue that buybacks aren't just about corporate strategy. They're about market psychology. Because when investors expect short-term performance, companies feel forced to deliver short-term results, and buybacks become the easiest path. Let's go deeper. Many large shareholders, including hedge funds and activist investors, don't hold stocks forever. They may stay for a few quarters, maybe a year or 2 years. They want results, fast. So when these investors see excess cash on the balance sheet, what do they say? Return it. Buy back shares, boost the stock. And if the company refuses, they may face pressure, activist campaigns,
boardroom fights, stock downgrades. So now buybacks aren't just a choice, they're a defense strategy, a way to keep investors happy, or at least quiet. And this isn't rare, it's common. Across industries, across countries, the pressure to deliver quarterly performance is everywhere. That's the tragedy. Because while the market wants companies to grow, it often punishes them for investing in that growth. Research and development? It's expensive, uncertain, takes years to pay off. But a buyback? It boosts numbers this quarter. It supports the stock price, and it rewards executives, many of whom may not be around in 5 years. So now we have a system where long-term thinking gets sidelined and short-term moves get rewarded. Not because companies are evil, but because the game is structured that way. That's the system we've built. And that leads to the big question. Is Wall Street shaping corporate behavior in a way that's unhealthy for long-term value? Because if every company plays this game, if they all chase short-term gains through buybacks, then who's left building for the future? This is where economists, policymakers, and even former CEOs have started to speak out. They ask, should we rethink how we measure performance? Should we shift incentives? Should we slow down? Because maybe, just maybe, we've created a market that moves too fast for its own good. And buybacks are just one of the symptoms. In Part 7, we'll explore the global picture. Are buybacks a uniquely American obsession, or are they spreading around the world? We'll look at how different countries treat buybacks, what cultural, legal, and financial systems make them more or less common, and whether global markets are following that path or resisting it. This is the long game, and we're not done yet. Thanks for listening.
Welcome back to The Long Game. In Part 6, we saw how the market, especially Wall Street, pressures companies towards short-term thinking, and how buybacks become a quick way to meet those demands. But now let's take a broader view. Let's go beyond Wall Street. Let's ask, is this just an American phenomenon? Or is the buyback mindset spreading across the globe? Let's start with the United States, because that's where buybacks have become most dominant. Over the past 2 decades, American companies have spent trillions on share repurchases. In fact, in many years, U.S. companies spend more on buybacks than on dividends, more than on capital investments, sometimes even more than on employee compensation. Why is the U.S. so heavily into buybacks? One reason is the regulatory environment. As we discussed in Part 2, in 1982, the SEC introduced Rule 10b-18, giving companies a legal safe harbor for repurchasing stock. This rule made buybacks not only legal, but predictable and protected as long as companies followed certain guidelines. Combine that with stock-based executive compensation, Wall Street's short-term mindset, and easy access to debt, and the result is a perfect storm, a system built for buybacks. Now let's head overseas. In Europe, the story is a little different. Buybacks are allowed in most European countries, but they're more tightly regulated. For example, in Germany, companies need shareholder approval before launching a buyback. There are also limits on how many shares can be repurchased in a given year. In France, buybacks are legal too, but often viewed with more skepticism. Dividends remain the more traditional way to return capital. In general, European markets tend to value longer-term planning, and executive pay is less often tied to stock prices than in the U.S. As a result, buybacks are used, but more cautiously. Now let's look at Asia. In Japan,
Buybacks were rare for decades, but recently they've become more common, especially as Japan tries to make its markets more investor-friendly. Companies like Toyota and Sony have started to buy back shares. Still, Japanese firms tend to hoard cash, sometimes excessively, and view capital return as a secondary concern. Culturally, preserving jobs and maintaining stability often rank higher than maximizing short-term returns. In China, the government has historically discouraged buybacks. But recently, Chinese regulators have started allowing more flexibility, especially to stabilize falling stock prices during turbulent times. That's an important point. In many emerging markets, buybacks aren't used for financial engineering. They're used for confidence building, a way to show investors that management still believes in the company, especially during market stress. And in Australia, Canada, South Korea, and other advanced markets, the trend varies. Some companies embrace buybacks, others still lean toward dividends. But overall, the influence of U.S. corporate behavior is spreading, slowly but surely. So what does this tell us? It tells us that buybacks are not universal, but they are becoming global. As financial markets become more connected, as executive pay structures shift, and as more companies try to copy American models of shareholder return, buybacks are making their way into boardrooms around the world. But that raises new questions. If the world follows the U.S. playbook, will it also inherit the same problems? Will global companies start chasing EPS at the cost of innovation? Will short-term pressures replace long-term purpose? Will workers, customers, and even the planet lose out? Because when buybacks spread without caution, so does the mindset behind them. So now we've seen buybacks from multiple angles: the accounting effects, the executive incentives, the market pressures, and now the global influence. In Part 8, we'll turn to the public debate, because buybacks have become political. Are they good for society, or are they contributing to inequality? Are they helping capital flow efficiently, or are they starving the real economy? We'll look at the critics, the defenders, the proposed reforms, and what it might look like to draw the line between smart capital return and financial makeup. This is the long game, and it's about to get even more real.
Welcome back to The Long Game. We've now explored buybacks through the lens of finance, psychology, incentives, and global trends. But in Part 8, we step into the arena of public debate. Because this topic isn't just about corporations and investors anymore. It's become political, emotional, even moral. So here's the question: are share buybacks helping society or hurting it? Let's begin with the critics. Over the past decade, voices from academia, labor movements, and government have grown louder, and they're asking hard questions. They point out that while companies have spent trillions on buybacks, wages in many industries have stayed flat. Productivity gains haven't translated into shared prosperity. And corporate profits keep climbing, even as workers get laid off. One of the loudest critics has been Senator Warren. She calls buybacks nothing but stock manipulation. In her view, they enrich executives and wealthy shareholders, but do little for the broader economy. Her argument is this: when a company chooses to spend billions on buybacks instead of investing in workers, innovation, or infrastructure, it's choosing short-term shareholders over long-term value creators. She's not alone. Senator Bernie Sanders has also attacked buybacks, especially in industries like airlines and healthcare. He's argued that companies using government bailouts to survive shouldn't turn around and reward shareholders with buybacks once the crisis passes. In 2019, Senator Chuck Schumer and Senator Bernie Sanders
even proposed a bill to ban buybacks unless companies paid a $15 minimum wage and offered benefits. So clearly, the conversation is changing. It's no longer just about financial efficiency. It's about fairness. It's about who benefits and who gets left behind. But what do defenders of buybacks say? Well, they argue that buybacks are just one tool, and often a responsible one. They say if a company has more cash than it needs and no better investment opportunity, why shouldn't it return that capital to shareholders? After all, the shareholders can then reinvest that money elsewhere, maybe into a company that does need it to grow. It's part of what makes markets work. They also point out that buybacks are more flexible than dividends. A company can stop buying back shares when needed without creating panic. But cutting a dividend? That often signals trouble. And defenders argue that many of the criticisms are based on extreme cases, not the average practice. Yes, there are examples of misuse. Yes, some companies buy back stock to hide poor performance. But many others do it responsibly, as part of a broader strategy, alongside investment, hiring, and innovation. So who's right? As always, the truth sits somewhere in between. Buybacks can be misused. They can reward the wrong behaviors. They can weaken a company's long-term position while enriching insiders. But they're not inherently evil. They're a tool. And like any tool, they can be used wisely or recklessly. That's why some experts have proposed reforms rather than bans. Ideas include limiting buybacks during times of layoffs, restricting executive stock sales right after buybacks, requiring stronger disclosures, encouraging more balanced capital return, like pairing buybacks with investment commitments. Others have called for tax changes. For example, taxing stock buybacks, just like dividends, to remove the incentive to prefer one over the other. And some suggest simply changing how we measure performance. If companies were judged less on quarterly earnings and more on long-term impact, employee satisfaction, and innovation, then maybe the obsession with EPS would fade. Because here's the bigger point. The way we reward companies shapes the way they behave. If we reward short-term moves, we'll get short-term thinking. If we reward durable growth, resilience, and purpose, we'll get better companies and maybe a better economy. So the buyback debate is really a mirror. It reflects what we value, what we encourage, and what we're willing to trade. In Part 9, we'll look to the future. We'll ask, where are buybacks heading? Are they here to stay? Or is a new era of corporate thinking on the horizon? We'll explore how artificial intelligence, ESG investing, and generational shifts in shareholder values might change the role of buybacks in the years ahead. This is The Long Game. Thanks for staying curious.
Welcome back to The Long Game. We've journeyed through what buybacks are, how they work, why they're done, and how they affect everything from corporate strategy to public trust. Now, in Part 9, we look ahead. Because this isn't just a story about the past, it's about where we're going. So let's ask, what is the future of share buybacks? Are they here to stay? Or are we on the edge of change? To begin, let's be honest. Buybacks have become deeply embedded in how public companies operate. For many boards of directors, approving a buyback is routine, almost automatic. For many investors, it's expected. But the world around those companies is shifting fast. Let's start with generational change. Younger investors, millennials and Gen Z, are growing in influence. And their values aren't always the same as previous generations. They care more about purpose, about sustainability, about how a company treats its employees, the environment, and society at large. To these investors, a massive buyback, while workers are being laid off, feels wrong.
It sends the wrong message. And as this generation builds more wealth, their preferences will matter more. Companies that ignore this may find their brand and stock under pressure. Next, let's talk about ESG, environmental, social, and governance investing. In the past, success was measured in profits and stock price. Now, more and more investors look at how those profits are made. They want to know, does this company care about climate risk? Is it investing in its workforce? Does it contribute to a stable, fair economy? And if a company chooses buybacks over those things, it may score lower on ESG metrics. It may lose favor with institutional investors. It may be left behind. Some large asset managers, like BlackRock and Vanguard, have already hinted that capital allocation decisions will come under greater scrutiny. Not just whether a company returns money to shareholders, but how and why. Now let's add another layer: technology and transparency. Artificial intelligence is making it easier than ever to analyze corporate behavior, to detect patterns, to compare capital spending, hiring, innovation against buybacks. Investors, both retail and institutional, now have tools to ask harder questions. They can look at long-term R&D trends, see when executives sold shares after buybacks, spot red flags. In the past, these things were buried deep in financial reports. Today, they can be surfaced in seconds. That means companies will face more accountability. And if they use buybacks to disguise weakness, they're more likely to be found out. Now let's consider policy and regulation. Governments around the world are watching buybacks more closely. In the U.S., the Inflation Reduction Act introduced a 1% tax on stock repurchases. It's small, for now, but it's a signal. A door has opened. Other proposals include higher taxes on buybacks, limits during layoffs, closer tracking and reporting of executive stock sales, requirements to pair buybacks with other investments. Whether these rules expand depends on politics and public pressure. But the era of silent buybacks may be ending. Now let's talk about the bigger shift. In a world facing climate change, inequality, and economic instability, the role of corporations is being redefined. More people are asking, what's the purpose of a company? Is it just to raise EPS? Or is it to create long-term value? For shareholders, yes, but also for employees, customers, and communities. And in that world, buybacks may look different. They may be smaller, less frequent, more strategic, more transparent, tied to broader goals, not just stock price. Companies may need to justify their buybacks, not just announce them. They may have to show that they're not giving up something better. Because the smartest companies of the future won't just be measured by what they return to shareholders. They'll be measured by what they build, protect, and sustain. In Part 10, our final episode in this series, we'll bring it all together. We'll ask the question that's been at the heart of this journey. Are buybacks smart capital return or financial makeup? And we'll explore how to tell the difference so you, as an investor, can make better decisions. This is the long game. Let's finish strong.
Welcome to the final part of our 10-part series here on The Long Game. If you've been with us from the beginning, thank you. You followed the numbers, the motives, the history, the controversies, and the global impact of one of the most powerful tools in modern corporate finance, the share buyback.
And now it's time to ask, once and for all, are buybacks a smart way to return capital to shareholders? Or are they a clever way to apply financial makeup? Let's pause and recap the ground we've covered. We began with what a buyback actually is. A company uses its own money to buy back its shares from the market. That shrinks the number of outstanding shares and boosts earnings per share. In theory, it's a way to reward investors. It's clean, it's efficient, and it often raises the stock price. But we quickly discovered that the why behind the buyback matters more than the what. We saw that executives whose pay often depends on stock prices or EPS have strong incentives to do buybacks, even when the company's actual performance isn't improving. We saw how buybacks can create the illusion of growth. EPS goes up, but profits stay flat. Debt may increase, while long-term investments shrink. We examined the cost of choosing buybacks over things like research, innovation, employee development, or climate resilience. And we learned how Wall Street pressure, driven by quarterly expectations, fuels the fire. Companies feel they must deliver short-term numbers or face punishment. We explored how this culture isn't confined to America. Buybacks are becoming a global trend. Though different countries treat them differently, the influence is spreading. Then we entered the public debate. Critics argue buybacks deepen inequality, that they favor shareholders over society, that they reward the rich and ignore the rest. Defenders say buybacks are flexible, rational, and smart when used right. And in Part 9, we looked forward. We saw how younger investors, ESG movements, transparency tools, and even taxes may change how buybacks are used in the future. So where does that leave us? Here's the truth. Buybacks are not good or bad by themselves. They're a tool. But like any tool, a hammer, a scalpel, a camera, it depends on how, when, and why it's used. There are times when buybacks are absolutely the right move. The company has strong profits, few better investment opportunities, a healthy balance sheet, and the stock is undervalued. In that case, buying back shares rewards patient shareholders. It shows confidence. It returns value. But there are also times when buybacks are used to paper over weakness, to satisfy short-term targets, to push up stock prices for insider gains, to avoid investing in people or the planet. In those cases, they're not capital return, they're financial makeup. So as an investor, what should you do? Start by looking beneath the surface. Ask, is this company growing? Are revenues rising or just EPS? Is the buyback funded by real profits or by debt? Are executives selling stock right after announcing a buyback? Has the company been cutting workers, cutting R&D, or stalling on product innovation? Because if a company is spending billions to buy back stock but neglecting everything else that builds long-term value, that's a warning sign. Also, look for balance. The best companies don't treat buybacks as the main event. They treat them as one tool among many. They invest in growth. They reward employees. They care about their customers. And when they've done all that, they buy back shares with what's left. That's the difference. It's not just what a company does, it's when and why they do it. So the next time you see a buyback announcement, pause. Ask, is this real value creation,
Or is it just a smoother-looking surface? Because if we as investors reward only the appearance of strength, we may end up weakening the very companies we hope to grow. But if we reward substance, we create space for businesses to think long-term again, to build, to invent, to lead. That's the long game, and it's the game worth playing. Thank you for listening.